Oftentimes when we want to value a company or a project, we have to work with accounting information. And so we have to be able to convert accounting variables into cash flows before we can calculate a project or a company's net present value. So in order to convert accounting variables to cash flows, we're going to use this top formula. Cash flows are equal to a firm's EBITDA, which is essentially their operating income, minus any taxes, minus capital expenditures, minus changes in working capital. And so in this equation, EBITDA, the firm's accounting income or operating income, is equal to their operating revenues minus operating expenses. Taxes are equal to the tax rate times the firm's EBITDA, again, their accounting income or operating income, minus any depreciation or amortization tax shields. And so essentially, this term in parentheses here is the firm's taxable income. And then finally, working capital, which is the inventory and cash that a firm needs on hand to run its day-to-day operations, is equal to inventory plus accounts receivable minus accounts payable. So in this example, let's use this example to see how we can convert this accounting information into cash flows. So in our example, we have a company that's considering a 2-year project, and this project is going to require a $100 million upfront capital expenditure. So in this box, we can write $100 million. Now this project is expected to generate revenues of $80 million in years 1 and 2. And it's going to have operating expenses of $25 million each year. And so at this point now, because we have the operating revenues and operating expenses, we can use our formula to calculate the EBITDA, the accounting or operating income in each year. So in year 1, our operating income, or EBITDA, is going to be $55 million. And in year 2, it's also going to be $55 million. We don't have any other capital expenditures in years 1 or 2, but we are told that we can depreciate this capital expenditure to 0 over the next 2 years, and we can use linear depreciation. And so what this means is that we can claim a depreciation expense of $50 million in years 1 and $50 million in year 2. And so effectively, what this depreciation expense is going to allow us to do is it's going to allow us to reduce our taxable income so that we have a lower tax burden. And so now when we're calculating our taxes, our taxable income is going to be our operating income, $55 million, minus this depreciation tax shield. So we get 55 minus 50, which is $5 million, times the tax rate, which in this question is 30%. And so we get 55 minus 50, which is equal to 5 times 0.3 is 1.5. So our tax burden for years 1 and years 2 is $1.5 million. And then finally, we're told that changes in working capital can be considered negligible in this example. So now we have everything we need to calculate the cash flows for each year. And so the cash flow in year 0, we're going to use this equation up here, is going to be minus $100 million due to this capital expenditure. And then in year 1, we have an operating income of $55 million. Our taxes are $1.5 million, and we don't have any capital expenditures or changes in working capital. And so we get 55 minus 1.5, which is 53.5. And similarly, we get the same thing in year 2. So now we have the cash flows for each one of our years. And now we're at the point where we can actually calculate the net present value of this project. And so the NPV of the project is going to be equal to minus 100 plus 53.5 divided by 1 plus our cost of capital, or discount rate, which in this case is 6%, 1.06 plus 53.5 divided by 1.06 squared. And so if we compute this expression, we find the NPV of this project ends up being negative $1.91 million. And so we see in this case, the NPV of this project is negative. And so because the project has negative value, they should choose to decline this project.